Donald Trump, Sam Zell, Jerry Jones. They all have one thing in common: they became billionaires through real estate while most people stay broke. It's not because they're smarter, it's because they understand a system that the average person doesn't. In the next 10 minutes, I'm breaking down exactly how the real estate wealth machine works. Welcome to the capital. Today we're doing a deep dive into one industry, real estate. Not just how to flip houses for profit, but how billionaire real estate moguls use the system to accumulate generational wealth. By the end of this video, you'll understand why real estate creates more millionaires than any other industry, and what separates billionaires from everyone else. Welcome to the capital. Today we're doing a deep dive into one industry, real estate. Not just how to flip houses for profit, but how billionaire real estate moguls use the system to accumulate generational wealth. By the end of this video, you'll understand why real estate creates more millionaires than any other industry, and what separates billionaires from everyone else. Let's say you have $100,000. You could put it in the stock market for a 10% return, or you could use it as a down payment on a $1 million property. If that property appreciates just 5%, you've made $50,000 on your $100,000 investment. That's a 50% return. Plus, tenants pay rent, which covers the mortgage. So you're building wealth using other people's money. This is the real estate wealth machine. It's called leverage, and it's why billionaires love real estate. Real estate moguls don't get rich from one property, they build a portfolio. Let's look at a simplified version of how this works. Year 1, you buy your first property with $100,000 down, it appreciates $50,000. Year 2, now you have $150,000 in equity. You use that to buy a second property. 2 properties, same original capital. Year 3, you buy a third property. Year 5, you own 5 properties. Each one is appreciating. Each one has tenants paying down your debt. By year 10, you might own 20 properties, most of them financed by banks, but the appreciation and rent are flowing to you. Now multiply this across different markets. A mogul might own apartments in New York, office buildings in Los Angeles, retail space in Miami, industrial warehouses in Dallas. Diversification across sectors and geography reduces risk while scaling wealth. But here's where billionaires get really smart: tax advantages and corporate structures. They use strategies like depreciation, where you claim a paper loss on an appreciating building to reduce your taxable income. With a 1031 exchange, they sell a property and use the proceeds to buy another, avoiding capital gains taxes entirely. Moguls can build a massive portfolio while never paying capital gains, and they don't hold properties in their personal names. They use LLCs to protect their assets. The result? A mogul might own properties worth $500 million but pay almost no income tax, while stock market investors pay hefty capital gains. Now, let's talk about billionaires who take this to the next level: institutional real estate. Companies like Blackstone are buying entire apartment complexes and neighborhoods. They're using different leverage. Instead of bank loans, they're raising money from institutions and foreign investors. Here's how it works. Blackstone raises $10 billion from pensions, insurance companies, and wealthy investors. They use this capital to acquire $40–50 billion in properties, 4 to 5x leverage. These properties generate rent. That rent returns to their investors while appreciating in value. Blackstone takes a 2% management fee on all assets under management. If they manage $500 billion in real estate, that's $10 billion in annual fees. Their executives become billionaires just from fees, not even from appreciation, and they have access to something individual investors don't: institutional borrowing rates. While you might get a 7% mortgage, Blackstone gets 3% interest because they're borrowing billions. This spread, the difference between what they earn from rent and what they pay in interest, is pure profit. Here's the part most people miss: real estate creates generational wealth in a way stocks don't. When a real estate mogul dies, their properties don't disappear, the family inherits them, but more importantly, they get a stepped-up basis, meaning the property value resets for tax purposes to the current market value. So if a mogul bought a building for $1 million in 1980 and it's now worth $100 million, the heir's cost basis is $100 million, not $1 million. When they sell, they pay capital gains tax on $0 profit. It's a massive tax loophole. Meanwhile, if someone's ancestors bought Apple stock in 1980, it's now worth millions. The heir has to pay capital gains tax on all that appreciation. Real estate compounds generational wealth in a way almost nothing else does. Real estate moguls aren't smarter than you. They just understand a system, leverage, depreciation, tax structures, and institutional scale. The banks give them access to billions because real estate is tangible. This is the capital. Next week, we're breaking down how young billionaires under 30 are getting rich using completely different methods. Subscribe so you don't miss it.